The year is 1907. It's a beautiful fall day, and you decide to withdraw some money from your bank account. You walk up to the bank, but guess what? You're not allowed to enter. You press for answers, but the banks remain silent. Later on, you find out that you're not even allowed to take out your own money. I mean, not even a dime. This was the reality of the Wall Street panic of 1907. And the reason? Well, two men whom you've probably never even heard of. They decided to run a get rich quick scheme. They thought that they'd manipulate the stock market to make an ungodly amount of money. But then their plans backfired, causing a monstrous financial backlash. In just a matter of days, they caused a widespread panic that led to interest rates skyrocketing from 9.5% to a staggering 100%. The New York Stock Exchange nearly loses 50% of its value, commodity prices drop by 21%, bankruptcy skyrocketed by 47%, and all because two men, Augustus Heinze and Charles Morse, just wanted to make a quick buck. But first, let me paint a picture of how things were a few years before this incident. You see, America wasn't exactly doing well. The economy was fragile, and financial cracks had begun to show. Then came the San Francisco earthquake of April 1906. The disaster led to the death of around 3,000 people, causing an estimated $400 million in damages. That would have been over $13 billion today. It triggered a massive insurance payout from British firms, draining gold reserves from the United Kingdom and forcing the Bank of England to raise interest rates. In response, the US followed suit. It began tightening credit, which put even more strain on an unstable financial system. You see, money dried up across the country. Banks ran low on cash, and businesses were starting to fail everywhere. But during this chaos, Heinze and Morse saw an opportunity. One of them was desperate, and the other was swimming in wealth. But they both had one thing in common. They were both devoid of morals. To understand how these two were capable of almost bankrupting America, we need to understand who they are and why they wielded such enormous amounts of power. We also need to understand the events that got them together to hatch these disastrous schemes. Let's talk about Heinze first, one of the infamous Copper Kings. He was no stranger to unethical schemes if it meant making a profit. He made a name for himself in Butte, Montana. This was the frontier district drowning in copper wealth. At the time of his arrival, one company had seized control, Amalgamated Copper. This was a massive conglomerate backed by an even more formidable corporation, Standard Oil. Ruthless and powerful, the firm swallowed up competitors and ruled the region with an iron grip. But for someone as cunning as Heinze, its sheer dominance meant an opportunity. He didn't want to break the monopoly out of principle. Instead, he wanted a piece of the fortune, and he didn't care how he got it. He quickly set to work. In 1895, he bought the Raris mines, a property bordering Amalgamated's operations. Then he launched a war on two fronts, one in the courts and one literally underground. He buried Amalgamated in over 100 lawsuits, tying them up in endless legal battles. But while they fought in court, Heinze's men took the real fight into the mines. His workers tunneled under Amalgamated's claims, broke through their shafts, and stole over $1 million worth of high-grade ore. Now, look, you'd think this was illegal, right? But hold that thought, because I'd like you to subscribe to the channel if you haven't already, because it really helps me out. But on a serious note, really, doesn't stealing over $1 million worth of high-grade ore seem illegal to you? But you see, Heinze was just too smart for the law. He twisted Montana's apex laws, exploiting legal loopholes to justify the theft. And if that failed, he had a backup plan. And that was Judge William Clancy, a close ally who ruled in his favor at every turn. With Clancy's help, Heinze convinced the courts that Amalgamated was an illegal monopoly. For a moment, it seemed like he had outmaneuvered one of the most powerful trusts in America. But power comes at a price. The endless legal battles drained his resources. As the case got wider attention, the tide turned against him. And in 1906, he cut his losses, sold his mining rights, and moved to New York. It is here that he would cross paths with an even bigger schemer, Charles W. Morse, the Ice King. If Augustus Heinze was ruthless, Charles Morse was a completely different creature. He wasn't your typical schemer, because he was a man who built entire industries, but on deception, bribery, and fraud. You see, from a young age, he always tried to leverage his smarts without any concerns for ethics. It started small. You see, as a teenager, he convinced his father to offer him a salary of $1,500 to keep the company books. But then he simply outsourced the job to someone else for $500 and pocketed the difference. This was his first real profit earned through not hard work, but manipulation. As he grew up, his schemes became even more ambitious and malicious. While he was still a student, he somehow brokered deals in New York to ship massive blocks of Kennebec River ice to the city's desperate residents. But he didn't stop there. Instead of sending his ships back empty, he filled them with southern lumber and coal for Maine. Through this, he made over $100,000 even before he graduated. Adjusted for inflation, that's nearly $3.5 million today. By the turn of the century, Morris had done the unthinkable. He took over nearly every ice company on the East Coast and consolidated them into the American Ice Company, a $60 million empire. That would be about $2 billion in today's money. The newspapers crowned him the Ice King. But behind the headlines, his methods were anything but noble. With his ice monopoly secured, he set his sights on something even bigger: finance. Flushed with cash, he took control of the National Bank of North America and the North Amsterdam National Bank. He also became a major shareholder in the Mercantile National Bank. One by one, he pulled the strings of New York's financial system. He wanted to bend Wall Street to his will. The stage was set. There was one man who was a mining outlaw and another who was a financial predator, and both were dreaming of schemes that would push the country to the brink of collapse. Now, it wasn't long before they both got entangled in each other's ambitions. Morris saw Heinze as a kindred spirit, someone who was bold enough to take risks, ruthless enough to break the rules, and reckless enough to play a game even Wall Street feared. With Morris's help, Heinze rebounded from his earlier losses. Heinze was given the rein to 6 national banks, 10 state banks, 5 trust companies, and 4 insurance firms. I mean, the two became really close allies. Once a lone opportunist, Heinze was now Morris's partner in crime. Together, they set their sights on a new scheme, one that would make them unimaginably rich, or so they thought. The plan was simple and had originally been devised by Heinze's younger brother, Otto. You see, Otto was sure that many investors had bet against United Copper Company, expecting its stock price to fall. If he was right, he and his partners could trap them in what is called a short squeeze. So this is basically how a short squeeze works. So Otto suggested that Heinze and Morris should buy as many shares as possible. This would drive the price up and force those who bet against it to buy back the shares at a much higher price. And if it would work, they would make a huge profit. That's basically a short squeeze. Now, to pull it off, they needed capital, and a lot of it. And for that, they turned to one of the largest financial institutions in the country, the Knickerbocker Trust Company. Now, it was also helpful in their plan that this massive financial firm was now headed by one of their old associates, Charles T. Barney. Barney had been involved in their past financial dealings, and trust companies like Knickerbocker operated with fewer restrictions than traditional banks. That made them the perfect avenue to help Morse and Heinze pull off their risky bet. Now, more than anyone, Barney would go on to regret his part in this. You see, unlike national banks, trust companies were lightly regulated, and they had far less cash in reserve. It was only about 5% of their total deposits compared to 25% required for national banks. This made them more profitable, but also vulnerable to sudden shocks. And their clients weren't your everyday people, but bigwigs with even bigger risk appetites. Trust companies played a different role to banks. They loaned large sums of money directly to Wall Street brokers, who then used this money to buy stocks. But these loans were often given out without any collateral, but they had to be repaid by the end of the day. So what would happen is these brokers would use the stocks they purchased as collateral for a second loan from a national bank, and that call loan was then used to repay the trust company by nightfall. So with Barney's help, Heinze and Morse funneled large sums of money into their plan, but they had a fatal miscalculation. You see, Heinze had assumed that they could control most of United Copper's stock, but he was wrong. Short sellers found other sources to buy from, and their trap failed. On October 15, 1907, the scheme collapsed. United Copper's stock price crashed, and panic set in. The reckless gamble had backfired. Now, the entire financial system looked like it was at risk. The week between United Copper's collapse on October 15th and Knickerbocker's closure on October 22nd was like a slow-motion train wreck. As news of Heinze and Morse's connection to Knickerbocker spread, worried depositors began to quietly withdraw their funds. What started as a trickle soon became a flood. But on the morning of October 22, 1907, the panic had truly begun. A growing crowd of depositors gathered outside Knickerbocker Trust Company's headquarters. They were desperate to withdraw their money. The news of Heinze and Morse's failed scheme had spread widely, and confidence in the trust companies was crumbling. Inside, the clerks worked as fast as they could, handing out cash to anxious customers. But in just a few hours, Knickerbocker had paid out $8 million across its 4 New York offices. But it wasn't enough. The trust was running out of money, and by early afternoon, it shut its door to desperate customers, and it wouldn't reopen for nearly 5 months. For those reading the newspapers that morning, the crisis seemed under control. The front pages of the Wall Street Journal and the New York Times reassured the public that the New York cleaning house had the situation in hand. Their headlines oozed confidence. The financial sector was strong, the markets were steady, and there was no reason to worry. But the reality told a different story. This was just the beginning, and the storm was only getting worse. Knickerbocker's trust failure had sent shockwaves through the financial system. A crisis of confidence took hold, and fear spread like wildfire. If one of the largest trust companies in America could collapse overnight, what about the others? The banks that had lent money to Heinze and Morse were now facing their own reckoning. Lines formed outside these banks, and more. People were no longer trusting that their savings were safe. The panic wasn't just about Heinze and Morse anymore. It was about the entire financial system that was on the brink. So the panic spread to other New York trust companies as well. Customers were worried that their banks had similar reckless bets, and so they were suspicious if their deposited money was actually safe. As trust companies crumbled, other banks scrambled to protect themselves as well. They pulled their reserves from Wall Street, cutting off cash to the stock market. The fear only made things worse. The panic swept like an unstoppable fire, consuming everything in its path. Banks stopped lending, trust companies hoarded whatever cash they had, and the halls of Wall Street, once teeming with eager investors and rapid trades, was now eerily silent. As fear gripped the market, interest rates skyrocketed from 9.5% to a staggering 100%. At times, no one was willing to lend at any price, and without credit, businesses could not pay their workers, investors couldn't cover their losses, and companies began to collapse under the weight of uncertainty. Uncertainty gave way to chaos in a rapidly escalating cycle of sell-offs and bank runs. The New York Stock Exchange spiraled downwards, losing nearly half of its value in a matter of weeks. Fortunes vanished overnight. Commodity prices plunged by over 21%, choking industries that relied on stable markets. Bankruptcies surged by 47%. And then came the layoffs. Factories shut their door, offices emptied. Unemployment, once a low 2.8%, now shot up to 8%. Millions found themselves without any work in an economy that was seized up completely. What had started as a scheme by 2 people to manipulate a single stock had spiraled into one of the worst financial disasters in American history. As the crisis deepened, there was no government safety net, no central bank to step in, and if the bleeding didn't stop, the entire country could plunge into collapse. Wall Street had placed its last hope on one man, JPmorgan, the most powerful banker in America at the time. He had the wealth, the influence, and the experience to pull the country back from the brink, but even he knew that he couldn't do it alone. Morgan called an emergency meeting at his personal library. The city's top financiers, bankers, trust company executives, and Wall Street leaders all gathered under his roof to find a solution. Tension filled the room. The stock market was on the edge of collapse. Major banks were failing, and no one wanted to be the first to sacrifice their own reserves to stop the panic. But Morgan had no patience for hesitation. He locked the doors. No one was allowed to leave until a plan was finalized. For hours, they argued and negotiated. The atmosphere was tense, while the rest of the country held its breath, anxiously awaiting salvation. But by the early morning, a deal had finally been struck. Morgan and his closest allies raised $3 million to prop up the Trust Company of America, stopping another bank run in its tracks. Then he organized a $25 million rescue fund to stabilize the stock market, lowering the crippling interest rates that were suffocating Wall Street. But that wasn't all. He orchestrated another $30 million bond purchase to keep New York City running, ensuring that public employees got their paychecks. These large-scale bailouts restored some confidence in the economy, and the situation began to slowly normalize. By the way, I made a video about JPMorgan, so make sure to check that out here and subscribe to the channel if you haven't already. But here's the thing with JPMorgan. He refused to rescue Knickerbocker Trust. He let it fully collapse as a warning to reckless financiers. As for Augustus Heinze and Charles Morse, well, they were thrown out of the banking industry. I mean, it's not surprising. Morgan personally ordered their removal from New York's financial world. Heinze drowned himself in failure and alcohol, and finally drank himself to death by 1914. His younger brother Otto, whose ambitious plans had set the disaster in motion, was barred from the New York Stock Exchange. But instead of turning to alcohol, Otto disappeared into obscurity. His dreams of Wall Street dominance had shattered. The younger Heinze's scheme had backfired spectacularly, not just taking his fortune, but his family's legacy with it. Meanwhile, Morse faced prison for federal banking violations. He tried to flee to Europe before being caught and sentenced to 15 years in prison. But prison wasn't the end of Morse's story. Behind bars, he befriended a fellow inmate, Carlo Ponzi, and took him under his wing. I'm sure that name rings a bell, right? Now, whether Morse explicitly taught Ponzi the tricks of financial fraud will never be known, but their time together likely influenced the notorious con man's future. Named after him, the Ponzi scheme would become one of the most infamous financial scams in history. Now, as for JPMorgan, he was initially hailed as a savior of Wall Street. However, suspicions grew. The public questioned whether he and other powerful financiers had just too much control over the economy. A committee was set up to investigate these so-called money trusts. It sought to uncover the immense influence that Morgan and his associates wielded over American banking. But for Charles T. Barney, their collaborator, the collapse was more than financial. After being forced to resign from Knickerbocker, he returned to his Manhattan home in November 14, 1907, and took his own life with a revolver. The man who helped enable Morse and Heinze's schemes became another casualty of their reckless ambition. Now, while Morgan refused to save Knickerbocker Trust initially, the institution eventually reopened in March 1908 after a painful restructuring. Now, it would never regain its former glory, ultimately being absorbed by Columbia Trust Company in 1912. And then in 1914, the same year that Heinze drank himself to death, JPMorgan also died. He had exhausted himself from the relentless pressure of being the nation's unofficial central banker. Now, JPMorgan's power had saved and supported America's economy, but the era of unchecked Wall Street titans was coming to an end. The Panic of 1907 marked a turning point in the evolution of modern finance. The financial system outgrew its safeguards as the world became increasingly interconnected and markets became more complex. More than a century later, the 2008 financial crisis would follow an eerily similar script, proving that the risks of an expanding and unregulated financial world would only grow larger. Both crises began in New York's financial markets, spreading rapidly across the country and then the world. In 1907, the failure of Knickerbocker Trust triggered widespread panic, and then in 2008, it was Lehman Brothers. Both institutions lacked access to a lender of last resort, and their collapses sent shockwaves through the financial system. The parallels don't just stop there. In 1907, JPMorgan personally organized the rescue of major banks, just as the Federal Reserve and the U.S. Treasury stepped in to prevent the total collapse in 2008. The bailout of Bear Stearns in 2008 closely mirrored the support received by the Mercantile National Bank in 1907. Both firms were saved through emergency interventions, while others were left to fail. The response to each crisis reshaped the financial landscape. You see, after 1907, the US government recognized the need for a central banking authority, which led to the creation of the Federal Reserve in 1913. The idea was to prevent future panics by providing liquidity in times of financial distress. And in 2008, a different lesson was learned. The crisis exposed the dangers of an unregulated financial system, particularly in the realm of shadow banking. Basically, non-banking institutions played a massive role in global finance, and they weren't subject to the same rules as traditional banks. In response, lawmakers passed the Dodd-Frank Act in 2010. It imposed stricter regulations on financial institutions and created new oversight mechanisms to tame risky behavior. Now look, the Panic of 1907 proved that financial history doesn't just repeat itself, it rhymes. From the ruins of Knickerbocker Trust to the ashes of Lehman Brothers, the lessons remain the same. In the world of finance, Unchecked ambition can threaten not just fortunes, but entire economies. Now, speaking of ambitious financiers, the story of how JP Morgan actually built his wealth that led him to save Wall Street later on is just as fascinating. I made a video about that, so check it out over here. And if you've made it this far into the video, please leave a $sign emoji in the comments. Thanks so much for watching. Please do subscribe if you haven't already, and I'll see you on the next one.